You've been arguing that Ukraine tensions actually haven't been felt much in global assets at the moment. What about in the last 2 days?
Yeah, they certainly have in the last 2 days. So natural gas prices, of course, have gone up, and you've also seen oil prices react, although they're coming off a little bit right now. So I would say that they are being priced in the energy complex, but it really is quite hard to see them being priced outside that, right? So you've seen equities come off a little bit, but if you look at consumer durables, because that's the one sector or the subsector that would definitely be impacted through weaker growth and higher inflation. In Europe, that sector is doing much better than it is in the US. So it's a little bit hard to similar things for US high yield relative to European high yield. US high yield is underperforming. The euro is doing just fine. EMFX volatility is actually quite low. So markets are watching, but I wouldn't say that the markets are reacting in a big way just yet to Russia, Ukraine outside of energy. So that's really the channel. You got to think of this as a potential supply shock for oil, and markets are not reacting that much. One of the reasons I think the markets are not reacting is that they're taking the playbook from 2014, from Crimea, both the actual move into Crimea in February, March of 2014, and also the sanctions levied on Russia from July of 14 till about September. And through that period, what really happened was some parts of CEE/FX got impacted. Oil rose a little bit in the first iteration, came down in the second one. So not a lot happened in stocks. So really it became quite a local event. This time it seems much more serious, but I don't think investors want to completely append the way of thinking and probably want to look for hedges rather than completely change their core portfolio.
So where should they be looking at those hedges then?
Yeah, unfortunately, equity vol and bond vol are already very high, as you know, for different reasons. For the central bank, because of the central bank, I think the asset class to look at is actually FX, where vol is still very low. And similar to 2014, I would be looking at CEE/FX, places like dollar pole or dollar check. For hedges. Russian assets themselves have moved quite a lot. So they, along with energy, are pricing in a lot of risk, which also means that if the situation becomes better, then you really shouldn't see global equities seeing massive relief from that. You should see Russian assets and energy coming down a little bit. So Russian assets going up and energy coming down. But in terms of hedging the left tail, this scenario gets much worse. Rather than completely change your portfolio and start buying all defensives and start buying US relative to Europe, which we don't want to do on the tactical horizon, I think we probably hedge our portfolio through FX right now. If we have to do it within equities, we think DAX and European banks are probably the best hedges. That's a hedge, right? That's not arguing that these things are likely to go down. We think we're just hedging our core portfolio by buying puts along those dimensions.